Why don't we go back to the basics?
Let's do it.
Traditional economics would dictate that there are two main causes for inflation. There is demand pull inflation and cost push inflation.
Since the pandemic, the Federal Reserve and the federal government kept interest rates extremely low and increased spending via stimulus packages. Together, they had the effect of flooding the market with cheap money. Without that support, it is unclear how the US stock market would have performed. In a short amount of time, the S&P 500 doubled, surging to dizzying heights led by most of today's tech giants who enjoyed record performances throughout the pandemic. Further, lockdowns and government checks in the mail gave rise to an explosion in retail investors, spurred on by subreddits such as Wall Street Bets and meme stocks to the moon. This was compounded by the vast amount of fiscal stimulus, that is, buying government bonds or quite simply printing money. However, the issue with a raging bull market is that it can get derailed in a hurry. This is in scope with the Federal Reserve likely raising interest rates in March and again 3 or 4 times this year to bring US inflation under control. This means borrowing becomes harder and making payments will become more expensive, which hurts growth stocks and, in particular, unprofitable companies that are valued on future earnings potential. This, coupled with ongoing microchip supply chain concerns, a tight labor market, and a US stock market that may have gotten ahead of itself, are all reasons for a correction in 2022. Looking at January alone, the tech-loaded Nasdaq index is down 12%. The biggest of the tech stocks have been hit the hardest, with FANG index down 13%. Crypto assets are down a colossal 40% since November, with Bitcoin down 23% year to date. Bitcoin's price is down nearly 50% since November. Billionaire investor Jeremy Grantham, co-founder of Boston asset manager GMO, has called time on US stocks, labeling it a super bubble that is almost certain to burst. He says those that rode the gravy train for the past 25 years need to wise up and prepare for a future of inflation, slower growth, and labor shortages. Grantham is so certain of a looming crash, citing the scarcity of raw materials, baby boomers retiring, birth rates are declining, emerging markets are maturing, and geopolitical tensions are flaring, all trends decades in the making and almost unstoppable. He's predicting a drop of almost 50% in the S&P 500 and said no amount of intervention from the Fed could prevent it. To prove his point, he shorted the Nasdaq as a hedge. So how do you protect yourself from a 2022 crash and inflation? Not selling and riding out the crash is an option, but looking at history, it takes a long time to recoup losses. 25 years in the case with the Great Depression in 1929 and almost 15 years for the dot-com bubble in 2000 and 5.5 years for the GFC. Other advocates suggest putting your money in store of value assets such as property, gold, and silver. Cryptocurrency, being volatile, would be best avoided as it is not reliable. However, others argue Bitcoin can protect against inflation. Whatever the case, it seems the bear market is here to stay for at least 2022. What are you doing to protect your assets? Please share your comments below and don't forget to like and subscribe so we can bring you more great content in the future.